This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 66 was recorded on June 8th, 2017. I'm Erik Townsend. The U.S. dollar index broke down below a two-year trend line on Wednesday morning. The pound sterling was hammered in the days leading up to the UK election. And this morning brought us another ECB press conference. Meanwhile, gold had broken out to the upside, flirting with 1,300 earlier this week, until it was hammered just before Comey's testimony on Thursday, down losing over 1% in just a few minutes. So clearly, we need to talk to a currency expert this week in order to take stock of all this news flow. And we don't know of many currency experts with a stronger command of the global macroeconomy than Axel Merk, who will be joining me as this week's feature interview guest. Axel and I will discuss the ECB, the UK elections, the recent action in the pound sterling, the Eurozone outlook generally, U.S. monetary policy, particularly with respect to the risks of tightening into a flattening yield curve, and then finally on to China, Japan, and gold.
And I'm Patrick Ceresna. We taped this show a couple hours early this week, so our commentary won't include anything that happened after 2 p.m. on Thursday. Erik, I'm looking at that S&P 500, and everyone's been working up this Super Thursday with all of these events, and yet the S&P 500 really hasn't done much, holding up right near its highs. What's your take on the market here?
Well, more and more famous people are proclaiming that it's over, that high is in, that's it, it's all going to be downhill from here. And I just have to ask, why? Certainly, if you make the argument that on any fundamental metric, the equity prices are overvalued, well, yeah, that's been true for more than a year as far as I'm concerned. So, why right now? Why is this the moment when irrational exuberance suddenly stops? I guess a lot of people thought that Donald Trump would have a bad day with the Comey testimony, and that would be the catalyst. I don't really think that's what's going to do it. The thing that I do notice about this market, though, Patrick, and I want to ask you more details about this after our feature interview, is the huge skew that exists in E-mini S&P futures. I was saying several months ago, ironically, at some point if we get well above 2,400, I'll start thinking about accumulating puts. Well, those puts are ridiculously expensive, but the calls, if you want to buy a lottery ticket on just the momentum trade of this up move in equities, senseless as I might think it is continuing, boy, the premia on calls is super cheap. So that skew fascinates me. I want to ask you more about that. But for now, we should probably keep our market wrap going because I know everybody's excited to get to Axel Merk.
Well, Erik, I'll put together a quick chart that we can look at with our listeners in the post-game show. All right, so Erik, when we take a look at the currency world here, we see that the euro downticked and was a sell-on news event when Mario Draghi started talking. That certainly upticked the dollar index, now approaching the 97 handle. What's your take here on the dollar?
I'm really looking forward to getting Axel Merk's view on this because it's a hard read. On one hand, you can make the argument that the dollar's been weak because the euro has been strong leading up to these elections. And, maybe it's just an anomaly. But boy, we did break a 2-year trend line on Wednesday morning in the dollar index to the downside. Now, I think it's recovered back above that with this uptick on euro weakness. It's really going to be a question of seeing how the situation in Europe plays out. And I still see, frankly, the bullish fundamental argument, the secular bull argument for the dollar to move higher from here because of interest rate differentials, because of Trump's repatriation policies, and in general because the U.S. is not in as bad shape economically as the rest of the world. But the chart is really clear. We are in a downdraft here. So how far does it go? I want to ask Axel Merk his perspective because that's obviously his area of specialty.
Now, Erik, I want to take a look at this crude oil. Crude oil dumped yesterday on that inventory number. Why don't you fill us in a little bit more on what happened?
You talk about a setup. It was really, really varied expectations. Tanker Trackers, which has had a fantastic track record this year, was calling for a 7 million barrel drawdown, massive drawdown in crude oil inventories. When API came in at a minus 4.5 million barrel drawdown, that's less oil in inventory, that was definitely got people's attention, but still that drawdown is kind of expected for this time of year. So even though it was a fairly big one, yeah, okay. And then EIA, the official data on Wednesday morning, comes out with a 3.3 million barrel build on crude oil inventories. Cushing, Oklahoma did see a 1.4 million barrel drawdown, but the thing really was gasoline and distillates, the finished products. Gasoline, 3.3 million barrel build. Distillates, 4.4 million barrel build. Combination of crude, gas, and distillates together, called total product inventory, it was the biggest uptick in several years, I believe, on that news. That sent oil markets absolutely tumbling to the downside. We actually lost $2, it looked like, in about 6 minutes after that data came out. That's a really big move, and of course it's accelerated from there on Thursday afternoon. We're still looking at a 45 handle, actually almost 45.65 right now on West Texas Intermediate crude oil. Now, it's tempting, because I've been very bearish in my commentary in the last few weeks, to declare myself a genius and say, yeah, see, I told you so. But honestly, folks, it feels to me like this EIA data is a little bit bogus, because there were a lot of good analysts that really thought this was going to be a drawdown week. The tanker tracker guys have said that they've looked at this and they just can't find any mistake that they made. They're really questioning the veracity of the EIA data. Helped me out, was a tailwind for my trades, but I wonder if we might see a correction or a reversal in the other direction next week. I'm still bearish for the reasons that I've stated last week, but as I say, I don't think that this data report is maybe completely as real as it appears to be. So I think it's a little bit of an artificial tailwind for the bears, but I still have a bearish view for other reasons.
Well, you know what? I want to move on to gold here, because what a crazy week. Gold started off so strong early throughout the week. You know, we headed up toward the 1300 handle on the upside. Even on the other day, we had a nice uptick on all the gold miners, kind of giving this indication like gold was going to break out. And then literally just before the Comey testimony, suddenly the headline on the news is that someone dumped $4 billion of gold futures on the market, creating a big downdraft. I mean, my technical levels are still not violate on the downside, but making your head spin a little bit in terms of where the next major trend move is. What's your take on gold here?
Yeah, we were actually taping Axel Merk's interview when that happened. I looked at the chart and I said, Axel, gold's really holding its own here. He says, look back at your chart. It's not anymore. It just lost 1% in a matter of minutes. So you'll hear that in the interview coming up. I think, the thing that I can't reconcile, and I asked Axel about this, is I see a really broad sell-off in commodities generally. You see the CRB index breaking key technical levels, taking out its 200-day moving average. You see crude oil selling off very aggressively. Commodities generally are hurting. Yet gold seems to be holding its own. And yes, there was something crazy that happened this morning that caused a down spike in gold. But before that, in the face of really broad commodity weakness, gold was really holding its own. So I'm starting to wonder what's going on there. The upside break that we saw did go through a few key technical levels this week, not super persuasively after it's now reversed to the downside. I wouldn't be surprised by the time that our listeners actually hear this broadcast, though, if that down spike has retraced and we're back up to the upside again. We'll ask Axel for more perspective on gold as we get into the feature interview.
Let's move on to interest rates and bonds. And when we're looking at this 10-year Treasury, Eric, we have these yields still hovering around the 220 level. We really haven't seen any big pushes higher as interest rates just get stuck right at the bottom end of this range. What's your feeling here about the next move in bonds?
Well, I think it's to lower yields, and we did see the yield poke down below that 20 support level. I think it was 214 or 215 I saw earlier this week. We're back up to 219 or 220 as we're taping on Thursday afternoon. But I think we're headed towards probably 2% is the next, major milestone, then 1.80 after that, and then who knows, maybe a new secular low. I don't really have a strong view on whether that secular low is in or not. At this point, I'm just sort of watching to see what happens. I do think that at some point this business cycle is way long in the tooth. If you start getting into recession, we should be looking at flattening yield curve, which we're already seeing, and weaker bond yields, and that seems to be the trend. I think it's going to continue.
I noticed that there were some updates to the website. Why don't you share with our listeners what they can find on our homepage?
Well, it was actually an improvement that several listeners suggested, and I can't tell you how much I appreciate it, folks. We finally put a donate button on the website so that you can help us to defray our production costs. So if you've been enjoying MacroVoices, it's always going to be free. We're never going to make anybody pay for it. But if you want to do the right thing and help us out, we certainly will appreciate it because it's expensive to produce this program. So you can donate on the homepage with a quick and easy PayPal link. Just click the donate button. The other thing that we've realized is, although our long-term listeners know that we also have a series called Accredited Investor Academy, which is basically a 5-hour series that Aaron Chan and I put together before he moved on to Real Vision. It is boot camp for accredited investors, high net worth individuals who are qualified to invest in hedge funds, in private equity, in venture capital, in angel investing, and so forth. And it's basically a boot camp on the ins and outs and ups and downs of all of the things that are only available to accredited investors. That's been there all the time, but we've just realized that nobody seems to know about it. So we've put a prominent button on the website where you can click the blue button in order to go directly to the Accredited Investor Academy page, which of course is also free at MacroVoices.com. So that's what we've done on the website, and we sure do appreciate your support for those of you who would like to donate.
Thanks, Erik. Now, returning this week as our featured interview guest is Axel Merk, President and CIO of Merk Investments. Erik's interview with Axel is coming up as Macro Voices continues right here at MacroVoices.com.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me next on the program is Axel Merk from Merk Funds. And Axel, boy, talk about a news day for us to be speaking on Thursday morning. There's so much to talk about, but let's start with the ECB. A lot of expectations were growing into this morning's ECB press conference that this might be that policy reversal moment akin to Ben Bernanke's famous announcement of the tapering of stimulus that might reverse the whole direction of ECB policy. Tell us what actually happened, and let's probably broaden it from there into what you see in terms of implications for the Eurozone generally.
Yes, well, great to be with you. And I think you set it up right. There was a lot of expectation heading into this meeting. And as a result of that, the euro had quite a run-up into that meeting. And not too surprisingly, at least in the immediate aftermath, there is some profit-taking, some selling of the euro. Now, if you look at the media, the media are no smarter or dumber than we are, but they got to do a job, and so they look at the immediate reaction. Euro dips down and say, all right, Draghi was dovish. And that doesn't even begin to scratch the surface. The most relevant thing, and it was anticipated, the most relevant thing is that Draghi pointed out that they are not going to lower rates any further. And they used to have that in the statement, and that's dropped. And so you would think that, yes, that means tapering is next. And if you recall, when Bernanke started his tapering, well, the tapering didn't start for years. There was always this anticipation. And of course, in the meantime, the dollar was rallying because the Fed is going to be so hawkish. And we're going to talk about the Fed later, I presume. Now, Draghi succeeded in the impossible in convincing the market that this is actually dovish. And the reason this is dovish is because they're not yet tapering. They didn't even, quote unquote, discuss normalization. He did point out that two on his board talked about it, but then he kind of said, nope, that was not a discussion, just them talking about it, because I presume he didn't engage and he didn't want to have it be called a discussion. He did say that the growth in the Eurozone is robust. He says the fear of deflation is over. The risk is only internationally, globally. Yet he is going to continue to print the same amount of money as he has because he doesn't have proof yet that we'll reach 2% inflation. And that statement that in some form or shape he has brought up in the past has kept folks at bay from further buying the euro in the short term anyway. Now, that said, the program currently, for those who don't watch the ECB every 5 minutes, the purchase program lasts until December. And everybody expects it to be extended, but at some point, probably in September, they will have to give us an indication of what's going to be next, how long is this going to continue, they reduce the number of purchases. So he'll have to face reality sooner rather than later. And the current low rates are just unsustainable for Europe. And so my own view is that the euro is going to get substantially stronger, especially in the context of other things I presume we'll be talking about in a few seconds or moments. Back to you.
As we're speaking on Thursday morning in the U.S., the polls are open in the U.K., but the result of the U.K. election is not yet known to us. It probably will be known to many of our listeners by the time they hear this program. It seems to me that there is a heck of a lot at stake for the U.K. in this election, and I can't help but notice that there was a heck of a lot at stake for the United States. It seems like elections in general are getting higher stakes. So what do you see as the significance of either outcome? What does it mean for the U.K.? What does it mean for the global economy in either result that might happen from today's election in the United Kingdom?
Yeah, if I give you my forecast, I'm sure I'm going to have egg on my face no matter what I'm going to tell you. I think, first of all, one thing that's very relevant is that historically you were on the political left or on the political right, and you chose your party accordingly. With the nationalist and populist movements we've had of late, and I don't think they're over by any means, those boundaries have been blurred. If you take in the U.S., for example, the typical Trump voter used to be a Democrat. Right now he's voting for Trump. So similarly, when it comes to Brexit, Brexit is more defined by age. The old people are going to be gone sooner rather than later. They wanted out of the EU. The young people wanted to be in. And now, historically, including the UK, the young people are leaning more to the left, and the older people more to the right. I happen to think that Theresa May is not your traditional conservative. And I'm not sure whether your audience is aware of that. She has proposed price controls on energy prices, for example. That is not something that, well, I guess Nixon did it, but it's not something that conservatives just traditionally do. She has proposed all kinds of things. And so when it comes to the significance, clearly what is relevant is as the UK is negotiating with the EU, a clear majority is helpful because then you have a mandate. And it doesn't really matter whether the majority is on the left or on the right. You just need a majority. And the goal of Theresa May is obviously to expand the majority. Now, she had not previously been elected to office. She is not, it appears to be, the typical person that would have bubbled to the top in a typical political discourse. And so she's had a couple of gaffes, including taking some retirement benefits away only to do a U-turn, and a few other things. And so I wouldn't be surprised if her support is going to be lackluster. Now, all that said, it doesn't really matter, because the reason it doesn't really matter is if you think about the way that the EU works, it's almost impossible to get anything done. And they have to renegotiate hundreds or thousands of pages of contracts, and they're very late to the game. And then they have to have unanimity in how they're going to pass that. I see it all but impossible to come up with a decent agreement. And so what that means basically is that there's going to be uncertainty. It's going to be difficult. The UK government will have to give huge incentives for businesses to move to the UK. Under Osborne, the previous government, they had austerity, and with austerity, they had bad deficits. I think they're going to have horrendous deficits going forward. I've said in the past that they're going to go down the Italian path, that, yep, they'll be okay, but it's going to be a cascadingly lower currency over time with higher inflation, and that's how they'll get things work. Now, the counter-argument to that is that they have the rule of law. It's good to be separated. They can found a new basis and so forth, and maybe they'll find their footing. But I think they'll have to make a lot of promises to keep their voters happy. And as we know from the world all over, including the U.S., backpedaling on those promises is very, very difficult. And so I do think deficits are going to be sky high in the UK for the foreseeable future, as my takeaway.
Now, you said earlier that you expected the euro to rally in the immediate short term in reaction to everything that's going on. At the same time, we've heard a lot of people opine that in the longer term, boy, the situation in Europe is just not good with exit contagion, more countries considering exiting and so forth. Do you see the beginning of a lasting, a bull market in the euro that has legs, or do you just see this as a short-term move higher in the euro?
Actually, short-term, I think there's profit-taking. Short-term, I'm not so sure we're going to get a rally. I think medium to long-term, there's going to be a rally. And yes, Europe is a mess. Europe has been a mess and will continue to be a mess. it is just darn difficult to weaken the euro. One of the reasons Europe is a mess is because they historically embrace austerity more. Austerity means consumers are saving more, they're spending less. That's a positive for a currency. People have this notion that you need to have economic growth to have a strong currency. That only applies if you're dependent on foreigners financing your deficits. In the European Union, that's not the case. The EU, with its twin deficits, that is the case. Japan, the more dysfunctional the economy is, the stronger the yen historically is. The UK is on the other side. The UK, you introduce barriers to trade, they have a trade deficit, the currency weakens. The euro can strengthen in that sort of backdrop. That doesn't mean things will be great in the Eurozone. And Draghi, this Thursday morning, said that the fear of deflation is over. And part of that is that the entire process, as dysfunctional as it has been in Europe, has been to get the Eurozone strong enough to stomach the default of a country or of banks. Indeed, just this week as we're talking, a Spanish bank failed, and the market didn't even blink. Now, it was a Spanish bank. You can argue that it was not systemically important, but still, the processes are starting to work. In the U.S., by the way, we have bank failures all the time, and the FDIC is stepping in, and the dollar doesn't have a fit. And the reason the dollar doesn't have a fit when these things happen is because you have a sound institutional process in place to handle these things. Now, do you have sound institutional processes in place in Europe? No, but they're getting better. And even in the absence of these institutional processes, you kind of know what policymakers are up to. You know the playbook. And once you know the playbook, you can price it in. You can work with those sort of things. Now, more importantly, maybe, Europe is taking over a lot of the funding from the rest of the world, or from the U.S. in particular. Warren Buffett issued euro-denominated bonds the other day. And there are a bunch of reasons for that. One is that the fear of the imminent crisis is over. The other one is that, and I don't want to get too much into detail, but last October, you might recall, we had changes in institutional money market fund rules. And the short of it is that those institutional money market funds had an implicit incentive to buy riskier assets than maybe they should have. European banks used to get a lot of their funding from those markets. Well, that's not as attractive anymore. So more funding is taking place domestically. And what that means, in addition to the low interest rates in Europe, is that the euro has become a funding currency. And that means that when times are good, the euro might weaken. But if for whatever reason, equity prices one day might go down, in the last couple of years, you've seen ever more frequently that the euro is actually rallying on these things. So if for whatever reason you might have a slightly negative outlook on equity markets or risk markets in general, I would not write off the euro. The euro can rally in those sort of environments. And I can go into that in more detail, but for the time being, I'd just like to keep it at that high level.
Let's move back to the United States. For the last several months, the theme that seems to be giving a tailwind to asset markets in the U.S. is the so-called Trump reflation trade, where a lot of people have believed that Mr. Trump would be able to achieve the many things that he set out to do, and it was going to be wonderful for asset prices and equities in particular. It seems that Mr. Trump's kind of running into some turbulence. As we speak on Thursday morning, James Comey, the fired FBI director, is testifying. That may cause some turbulence there. There's a lot of other things going on, and quite a few people have come out in recent weeks saying, okay, this Trump reflation trade is probably over now or ending. What's your view? Is Donald Trump saves the day played out as far as it's going to go, or is there more to this rally?
The Trump reflation trade is dead, except the equity markets haven't noticed it yet. And this isn't so much saying that Trump is great or horrible. He is just unlikely to get things done. Trump has a take-no-prisoner approach, and his supporters love him for that. But you don't make many friends with that. And he recently showed it to the rest of the world, the way he's been treating folks domestically. And that also means if you take the healthcare reform, Republicans can't agree on something. And part of that is that he hasn't rallied people behind his agenda. He probably doesn't care about healthcare all that much. He wanted to have the tax cuts. This week, as we speak, is supposed to be a week where he's touting infrastructure reform, a topic where you would think you can get bipartisan support. Well, he gets so distracted by the news that a recent rally, and I already applauded him for finally going out there and actually rallying by this point, something Obama did all the time. It doesn't really matter as far as getting things done, but once in a while you've got to, from the bully pulpit, also forward your agenda. Can't just do that on Twitter. Well, he didn't talk about infrastructure until very late into his speech. That is not how you rally people, and including those in Congress. Those guys, I mean, it's a zoo there. You've got to be playing babysitter. You've got to get these people in the right direction. And when you don't do that, it's more difficult to get things done. And so if you take healthcare reform, no sane person in the world wants to own that problem. I mean, the cost of healthcare is going to go up. It's only a question of the rate of increase. And so nobody is really vested in that and really pushing it. Yet you have Paul Ryan, who I think is a technocrat, who has some very good ideas, but is unable to sell those ideas. Basically what that means is you don't make any friends in Congress. You work with a technocrat. You don't provide the leadership. The short of it is you're not going to get many things done. Now, if you don't get many things done, you're going to do exactly what Obama did. You're going to rule by executive order. And those who love him will love it. Those who hate him will hate it. The implication, though, is that just like under Obama, investors in businesses will not make long-term decisions because these executive orders can be changed by the next guy or gal who's going to be in office. And so that is one of the key reasons why the bonds are again rallying, why we're not getting higher real rates. And for those of you who haven't noticed, I mean, we're talking about a Fed rate hike that's imminent. We're currently pricing in, if we're assuming that we're pricing in a total of 2.5 rate hikes for the year. That includes the one earlier this year, that includes the presumed June rate hike. That means after that, we're going to get another quote-unquote half rate hike for this year, and then a little less than one next year. That means after this coming rate hike, we're going to get one more rate hike. And that is an economy that's supposed to be booming, firing on all cylinders, where we're getting rid of the slack in the economy. Well, it means that the market thinks that this Trump rally is over. And the only folks who haven't noticed are the folks buying equities, and part of it might be that low interest rates warrant high equity valuations. That's well possible. But to me, it shows that we're going to have an administration that's not going to get all that much done. And sometimes that's not a bad thing, but many of these things that supposedly were the Trump trade have fizzled out, and the most direct answers in the bond market.
Speaking of the bond market, I want to go to the U.S. dollar next. We've had quite a few prominent guests on the program who have articulated a bullish secular view on the U.S. dollar. All those arguments made perfect sense to me, but boy, look at the chart. That's not what it's doing. Some people have dismissed that and said it's just short-term noise because of the strength of the euro. Others have said, no, there's a bigger picture here. So where do you see the U.S. dollar going? Is the rally that we've seen for the last couple of years set to resume, or are we looking at a reversal point here?
Well, we had 4 years of a dollar rally. If you look at a longer-term chart, we were 2 standard deviations above its average. And I'm not a technician, but to me that indicates maybe, just maybe, the dollar got ahead of itself. And I mentioned earlier, we had Bernanke, who said, hey, I'm going to taper. And by the way, the reason he wanted to taper, in my view, is because he was retiring. Similarly now, Yellen wants to normalize the balance sheet. It's not because of something happened in the economy. It's because she's retiring early next year. And by the way, we should talk about that, what's going to happen there. But when you have that sort of environment, you're letting the market anticipate, I'm going to be so tough. A year ago, it was more than apparent that the Fed is hostage of the markets. This year, the market delivered a rate hike on a silver platter. As long as the market allows the Fed to do that, it will continue doing that. But we seem to be at the end of the tightening cycle, whereas in Europe, we're at the beginning of the tightening cycle. And you can tell me all you want that things are better in the U.S. than in Europe, and I would even agree with that. But it's all relative to what is being priced in. And there, we're going to, now again, we shoved it out a few months. In September, probably, we're going to hear that, we're not going to buy quite as many securities. We're not going to extend the QE program as long as expected. That's the same sort of thing that Bernanke did that provided a tailwind to the dollar. And this one is providing a tailwind to the euro this time around. Also on trade, if we're going to have more trade disputes, that is a dollar negative. Now, the Mexican peso might suffer under that, and if indeed a war were to be built, but it's not going to happen because the U.S., especially corn export, for example, are so dependent on exports to Mexico. So this is wonderful in the tweet. But what is going to happen is that abroad, and Mexico has an election next year, you're not going to elect leaders that are U.S. government friendly. And so any trade renegotiation terms for the U.S. are not necessarily going to be better. And the folks who are suffering in a trade war, just broadly speaking, are those with a current account deficit. That's in my view, and the U.S. has a current account deficit. And so these tensions on trades, if anything, are going to hurt it. And by the way, I don't think we're going to get a trade war because of a renegotiated trade deal or failure thereof. I think we're going to get a trade war because the U.S. is going to assert itself in the South China Sea or similar place, and we're going to upset the Chinese, and they're going to retaliate with trade. I think that's the sort of dynamic that I see more unfolding. But the short of it is that the dollar has had a huge rally, pricing in amazing recovery, and the yield curve is flattening. That means the Fed is tightening into a weakening economy, whereas in the rest of the world, and Europe in particular, we have the cyclical recovery, and things are getting better there. So to me, over the next 18 months to 2 years, that means, the euro is going to strengthen. Now, you tell me what's going to happen in 20 years? Well, then we should start talking about entitlements and other things, which provide wonderful pressures in various directions in various markets.
I want to come back to those longer-term factors in just a minute, but first, let's go ahead and take that deep dive into U.S. monetary policy, because as you said, we've got the Fed hiking into a flattening yield curve, and that by itself really, to me, is a topic of conversation. Why does it make sense to be hiking into a very weak economy? But as you say, we know that Janet Yellen is going to retire. We know that Donald Trump is not going to reappoint Janet Yellen. We don't know what's going to happen next. How do you see things folding out for U.S. monetary policy in general? What other factors maybe that I have not brought up should we be thinking about?
Well, first of all, the Fed has an uncanny ability to tighten into a weakening market. They are always late, they always tighten, and that's why we get cycles. That's why, and some people say you can only have a bear market in stocks if you have a recession. I tend to then point people to 1987, where we had a crash without a recession. So maybe we're going to get our recession and then we finally get our bear market. Who knows? I attended a conference at the Hoover Institute at Stanford recently, where you had a bunch of Fed officials, some current, some former, debate what's going to happen in the next downturn, how we're going to do things, and so forth. And the question wasn't so much of whether we're going to go back to QE, but what should we do in the interim before we likely go there again. And what I noticed is that the folks who were not in charge, the folks who were more academically minded or were non-voting members, tended to be more on saying, hey, let's normalize the balance sheet all the way back to where we were before the crisis. And yes, we have to add a bunch of money because more currency notes on circulation. But otherwise we go back there. Whereas the folks who actually pull the trigger, so to speak, who are in charge, said, well, oh, no, it's much more complicated than that. And there was even a voice that said it lubricates the markets better because when you have a high balance sheet, you don't have all these differences in rates in the different markets, and that's all bad if you have it. Charlie Plosser, the former Philly Fed president, then said, well, maybe it's good that the market actually gives us some information. But where we're heading to, and I think the key question is who's going to succeed Yellen. I personally have my chips with Kevin Warsh. He was a Fed governor during the financial crisis. He's been positioning himself to be the next Fed chair. At that particular conference, he gave what I dubbed a campaign speech. Now, somebody pointed out to me afterwards that if he had been asked by the administration, he would shut up and not give a campaign speech anymore to be the next Fed chair. But the short of it is that his view is that folks at central banks shouldn't be rock stars. They should be quiet unless there's a crisis. He also points out that the only folks who have benefited are those holding financial assets. That's not the way to run the Fed. And so he wants to have a bunch of changes. And on top of that, we just had nominations for empty governor seats. Now, folks that are unlikely to dissent, but they are more in the quote-unquote rule-based camp. Some people have pointed out that means there will be more hawkish, but it also means one of them at least might be interested in going to negative rates rather than QE. The short of it is, though, when you have a new Fed chair come in, no matter who it's going to be, they come in with the best of intentions. And so take Kevin Warsh. He says, I am going to now probably hike rates because this is just bad, creating all these unintended consequences. Anybody at the Fed will tell you that they are not going to be moved by the markets if markets plunge. They're not going to change their outlook, their rate path, because markets plunge. But at the same sentence, they may well tell you that they will change where they think interest rates should be if financial conditions deteriorate. Now, you tell me what the difference is. Usually, when the market crashes, bonds rally, junk bonds plunge, and guess what? Financial conditions deteriorate. And so, yes, they absolutely react to stock prices. And so what you're going to have is you're going to have somebody brave come in. They're going to do something, probably dislodge the markets, pretend it doesn't matter, until a few weeks later they notice, oops, a recession happened or financing conditions are just horrible. And guess what? They'll lower rates and might move towards QE. And this is all, of course, in the backdrop of record low volatility. Low volatility creates higher asset prices because it reduces the risk in the market or perceived risk in the market. And so as volatility goes up, as asset prices should come down, good luck, fasten your seatbelt. That's the sort of thing that I anticipate with Fed policy over the next 18 months going forward.
You touched briefly on longer-term effects. I want to come back to that now because this is a subject that I feel a lot of passion for, Axel. You know, we're in an environment of what a lot of people think is the beginning of a secular stagnation where we're going to be stuck with very low interest rates for a very long time. And I just look at this and I think the most important social contract that we have in civilized society is this promise that we make to the firemen and the carpenters and the plumbers and all the people that actually work hard for a living. And what we tell them is that smart finance guys like us are in charge of this pension retirement system that's going to guarantee you just trust us and you're going to be comfortable in your retirement because we're planning it all out for you. Now, I look at this, Axel, and I don't see any possible way of averting a major pension crisis because the yield that's needed to support the models that industry is based on doesn't exist anymore. Am I missing something or is it really that bad?
That's pretty bad. Just abstractly speaking, the way you can deal with major obligations going forward is the big categories are growth, inflation, or default. And throughout the world, we have similar problems. And I think the way to survive this financially or to even make money is to think about culturally how different countries will react to these things. In the U.S., we don't need to default because we can print the money. Indeed, we have this magic wand called the printing press that's been bailing us out left and right. And we seem to be very willing and eager to use it. One scenario I can imagine is that Congress is going to ask the Fed to finance the infrastructure project. They've already asked the Fed to finance the credit agency, the Consumer Protection Agency, which is probably unconstitutional and whatnot. This came up at that conference the other day, and Charlie Plosser said this isn't an abstract topic because he was asked just that by somebody from Congress in testimony, whether that could happen. And so if we keep paying interest on reserves, there's a political minefield in many directions, but that may well happen. The other one, of course, is default, and default can happen in various ways. You can do an outright default, but if you use that term broadly, cutting benefits is also a form of default where you're reducing benefits. That is the most prudent way to go about it, but it's pretty darn difficult. I sometimes bring up the example that I live in Palo Alto, a fairly affluent community, and they wanted to shut down the local dog shelter, mostly because pension costs of the employees are too high. Well, guess what? It was impossible. It was impossible. If you can't shut down a dog shelter, how can you take away retirement benefits? Whenever we give a new benefit, it's almost impossible to take away. Just take the last days of the Obama administration. All kinds of things were assigned to put new benefits in place, and Trump is this horrible person for taking them away. And so whenever these things happen, the backlash is just tremendous, even on minor issues. Take healthcare, right? Now healthcare is suddenly, is it a right or is it a privilege, right? And oh my God, we have these millions of unemployed people. The only way you can contain the cost of healthcare is if you make people be part of that. If they feel that there is an expense, and unfortunately that means high deductibles. That means that they have personal responsibility. Is that something pleasant? No, and that is why it is so extremely difficult to push through reform that incorporate aspects of that. And we can talk about healthcare. I don't like any proposal of any of the Democrats or Republicans, but any program that is supposed to get our entitlements on a sustainable path has to involve the personal pain in some ways so that we have an incentive to actually keep the costs low. And yes, as long as we think that, hey, there's this magic wand around, it's not going to happen. And so in the U.S., I happen to think, and we have a pretty good printing press, we can do this for quite a while, but the math just doesn't work. This is unsustainable, and And it is fixable, but the political majorities to fix it, I just don't see them anywhere on the horizon.
Now, when you say it's fixable, do you mean it is fixable in a way that you would consider politically viable, or do you just mean in theory it could be fixed if people were willing to do very difficult things that in democracy they usually don't want to do because it doesn't buy anybody any votes?
Well, I mean, I've been asked many times over the years kind of what I would do, and I've kind of always given the same answer. And I think that same answer is also possible on a national political level, that the best short-term solution is a good long-term solution. If somebody, and you can plug in many different things. Indeed, I even think that there are solutions on both on the left and the right that could make the system sustainable. There doesn't seem to be the leadership to have that frank talk with the public saying, yeah, we are in a mess that we got to fix. Is it possible that we get that sort of leader that might do that? Yes. Is it possible that that leader might succeed? Odds are low, but not impossible. And so I happen to think that, yes, problems are fixable. Do I see anything in the near term or even in the next 6, 7, 8 years that's going to get us there? Most unlikely.
Let's keep the conversation moving around the world. Kyle Bass and a number of other notables have suggested that the Chinese debt situation is just so out of control that eventually a collapse of the explosion of credit expansion in China will force the PBOC to markedly devalue the yuan, and that could send a wave of deflation around the world big enough to maybe spark the next major financial crisis. You're a currency expert, Axel. Is that view crazy? Is that got some weight to it? How do you see this? What do you think is next for the whole situation in China with how much debt has been expanded since 2009?
It's a baseline scenario for us these days that set the timing of that is very, very difficult. And to just kind of link that to the previous question, one of the reasons I said 6 to 8 years is that the one wonderful incentive to get things done is a crisis. And you saw that in the top of the Eurozone debt crisis. Suddenly real reform took place. The key reason why we don't have reform in the U.S. is because we get away with things, because we got the printing press. And so similarly, if you move over to China, as long as things kind of stick together, they'll continue what they got to do. We used to have a mutual fund that used to belong to renminbi, and we shut that down once we turned negative. Indeed, our timing was pretty decent because the renminbi continued to appreciate until then, and the Kalbas was already negative in those days. Then we turned negative, and these days, and some other work we do, we short the renminbi for full disclosure. It is though something, you have a negative carry when you do that, so it costs you a couple % a year to hold that. And you're dealing obviously with a government that might stick around for a while, right? I mean, it's we have these things, oh my God, this deadline is coming up and everything is going to crash and burn on this specific date. And then more often than not, it doesn't happen because yet they pull another trick out of the hat and things are going to continue. Now, yes, the explosion of credit in China is breathtaking, and it's screaming that there's going to be an issue at some point. I had been positive on China, and the reason I used to be positive on China is because I thought you can fix China. And the way you fix China is to allocate credit more efficiently to small and medium-sized enterprises. In China, most of the money goes to the state-owned enterprises, and they are then pushed to build infrastructure things and so forth to get things going, whereas the small and medium-sized enterprises, they have to go to loan sharks, they have to go to the shadow banking system. And if you institute reform to allocate credit more efficiently and then gave them some sort of entrepreneurial boost, I sometimes joke that, hey, give them Ronald Reagan to give them a vision, meaning with propaganda you can do it, you could unleash an entrepreneurial boom. They didn't do that. They instituted a lot of reform until the IMF said you can join the special drawing rights basket here, but ever since then they have taken steps back. So you get this wording coming out that they're all open, but then they use their traditional reforms. In the meantime, of course, the key reason is that they probably have more billionaires in their Congress than the Trump administration has, and there's these vested interests to keep supporting the establishment at the detriment of the small and medium-sized enterprises. The reforms are just not taken care. And that means you have pushed things to ever greater extremes, And being active in the currency markets, one of the things we see is, well, how do they use the leverage? They often use, you might recall, we had a couple of years ago, we had this scandal where people used copper and other commodities as collateral for their trades, and guess what? People were pledging that same collateral multiple times. And one of the reasons they used physical metals as collateral is because that was one way to circumvent the capital controls and so forth. And so at this stage, they have tightened many of the capital controls, and everything looks good. And just because the waters are calm superficially doesn't mean you don't have a crisis brewing underneath. The timing of that is very difficult. I happen to think to short the renminbi at this stage at the carrying cost of minus, what do we have here? Minus 0.267% I see on the screen for a 12-month CNH roll. That's acceptable to me. Now, I'm not giving investment advice here because it is very difficult. Something could happen. But if you're looking at what crisis could happen in Europe or the U.S., yeah, let's blame China. And by the way, it's always wonderful to blame somebody else for your own problems. And so it's going to be the Chinese fault if everything falls apart somewhere else in the world.
Let's talk about Japan while we're in Asia. You know, a lot of people have been betting for not just years, but decades, saying, okay, this debt load in Japan is unsustainable. JGBs have to crash at some point because there's just, crazy debt to GDP ratio. But it goes on and it goes on. Some people think it's now coming unglued. How do you see the Japanese yen and particularly the Japanese treasury debt with JGBs?
The biggest threat to Japan is that their policies are working. And the reason I say that is that if their policies were to work, real rates would move higher. That means the JGB would need to plunge. For the time being, they can monetize their debt, and the market appears to accept it, and it's a waiting game. If you want to short the JGBs, it's inexpensive because rates are at zero there on the 10-year as well, depending on the day, even very, very low. And so when and what is going to blow up, who knows? The yen has been migrating between being this risk-off currency where it rallies when things are bad in the world, but with Abenomics, the euro, as I indicated earlier, has increasingly taken on that role, and so with the yen, we've changed our view numerous times in the last couple of years, and so right now I actually don't have a very strong view on the yen. Simply because you haven't had this buildup of pressures one way or another. I talked about the British election. Unlike some of the other events, if you looked at the French elections, the most important thing for the French election for currency traders, which is very unusual, appeared to be that they keep their job. And the reason I say that is people bought so much insurance about a Le Pen victory at the time that even if Le Pen had won, it's not the end of the world in France because she wouldn't have had a majority in the assembly, in the French assembly. And so that's when you get distortion and tension in the markets. If you look at the British election today, you mentioned earlier that it's very important. I beg to differ a little bit. The UK is becoming less and less relevant. And indeed, yes, there's a little bit of insurance people took out, but very, very little. People are kind of moving on from that election. And clearly, if there's an unusual outcome, the markets will have some fireworks. But what you don't have this huge tension right now. And similarly, if I look at the yen, there's no huge tension. It's not clear where the next policy move is going to be. I happen to be quite negative on risk assets, and that means there might be a short-term upward move in the yen, and that kind of balances my long-term negative view on the yen, and that's why I currently would not want to give a recommendation on the yen.
You know, I look at commodities in general really showing some weakness. The CRB has taken out its 200-day moving average in the last few weeks. We saw oil death crossing in the last couple of days on this move down. A lot of just general commodity weakness. But boy, I look at gold, and it's really holding its own pretty well here, considering everything else that's going on. What do you think is up with gold, and where's it headed from here?
Yeah, as we talked, gold is actually down a little over 1%, but yes, it's been holding.
As we've been speaking. Okay, I don't have my chart up. I'm in trouble.
It's probably whatever you have said, somebody's leaking it to the press. No, but seriously, let's talk. I mentioned oil here briefly. OPEC has been trying to, they obviously try to get the fracking folks out of business. These are all little guys. They are the marginal producers. And if you look carefully, the rig count in the U.S. has been steadily increasing. And it appears that in due course, the U.S. production will make up and then some for the cuts of OPEC. So OPEC is becoming less relevant, and that means supply will continue to increase. And from that point of view, I'm not surprised that as we talk, the West Texas oil is at under $46. I wouldn't be surprised if it's going to head lower. Overall, yes, the industrial commodities have been coming down. It's very compatible with a flattening yield curve, very compatible with the Federal Reserve tightening into a weakening economy. And the reason why, and gold is kind of has the least industrial use. It does have some industrial use, but the least industrial use of any of the metals. And so it's more of a monetary instrument. And as I indicated earlier, we're going to get probably one rate hike next year. Now, in the meantime, have you looked at the inflationary pressures building up on the wage side? We're going to be behind the curve. We are behind the curve. We have negative real rates in the way I look at it, real rates anyway. And so, yes, in that sort of environment, the biggest competitor to the price of gold is cash that pays a real rate of return. Going back to your earlier question about kind of fiscal sustainability and things like that, I don't see how we can have positive real interest rates a decade from now. Sure, in the short term, we get a new Fed chair coming in, and they're going to say, oh, my God, we're going to hike rates. We're going to do all kinds of great things. Yeah, that might be a competition to gold, although in an environment where almost everything is expensive, in my view, and the gold is not particularly underpriced, gold might shine very well if equity prices plunge. And so gold, one of the reasons gold does well, it's one of the easiest diversifiers. If you think about it from a different perspective, you're an investor, you allocate a portfolio, you have a 60-40 portfolio investing in stocks and bonds. Well, your equity portion has gone up. If you're at all prudent, and I allege many haven't been, you take chips off the table. But where on earth do you take those chips? Historically, you do it to bonds, but they don't yield anything. Now, if you chase yield, like most people do, well, the junk bond market or anything close to it is highly correlated with equities. And so you're not getting the diversification you're historically getting. And gold is just the easiest diversifier. I'm not saying it's necessarily always the best diversifier, but the reason I say it's the easiest diversifier is because over the long run, the correlation to equities is near zero. Otherwise, what you want to do in this sort of environment, you want to go to investments that are by design not correlated to equities, and very quickly you're going through some very complex stuff like long-short equity, long-short currency, other things that just most people don't want to deal with. And that is one of the reasons that gold is attractive to folks, because it's just an easy place to kind of get some balance to one's portfolio. That doesn't mean gold will always go up, but if you have a portfolio where everything is expensive, sure, you can use cash, but if you're a professional, you're not going to get compensated on cash, so you're going to choose something else for your investors.
On that note, Axel, I'd like to close with what you do over at Merk Funds, because you guys run currency funds. And as you said a minute ago, the old portfolio construction theory, 60-40 portfolio, stocks and bonds. Tell us not only what you do there, but where do currency funds fit into a portfolio, and what purpose do they serve in the overall portfolio construction?
Yeah, so I'm not going to be able to go too product specific here, but come to our website at merkinvestments.com and look around. But we do things on the currency side, we do things on the precious metal side, and then we do things also on the global macro side where we can go anywhere. Now, one of the reasons I was attracted to currencies in the first place, and by the way, I wasn't always on the currency side. We used to do fundamental analysis in equities in the 90s, is I just didn't like anything anymore. And then it was always about diversification. How do you get diversification in a world where things are more highly correlated? And there were different issues in the late 90s, obviously, and the run-up to the housing crisis. In 2005, we started the Hard Currency Fund, which was a play on a weakening dollar. That fund has been losing money for quite a few years of late as the dollar rallied, but it has done what it's supposed to do. It diversified to the dollar. We, by the way, outperformed many, many years our benchmark. And so if you think the dollar is going to weaken, that might be a play for people. And there is a loyal following that hasn't left, and competitors who've kind of changed the focus, their asset base completely evaporated. But the point of that was to have international exposure without the equity risk and with minimal interest risk. So by sticking to very short-term money market type of instruments internationally. And I happen to think there's value in that. Now, one of the things we do is we do long-short currencies where we combine both macro and more quantitative analysis. We do a lot of risk sentiment analysis. We think in an era where fundamentals are just distorted so much, you've got to look at other things. So when fear flares up in the currency markets, these markets move. They tend to move down. We have a white paper on that. And you can create a portfolio that, as fear is moving around the world, is rebalancing in a way that you would go, say, short the Swiss franc and long the Australian dollar, or whatever it might be. The returns you generate are almost certainly uncorrelated. And so in that sort of world, if you think that equity prices are not giving you diversification, then that's something to look at. And then we do something purely on gold. And again, look on our website what we do there, and everything else I can probably not discuss here what else we do. But the short of it is that we've increasingly done things in-house to just be able to get ready for markets that we expect. And the markets that we expect don't look pretty. And we think you've got to be very flexible and nimble, and the traditional ways of diversifying don't cut it simply because asset prices are too high.
Well, Axel, I can't thank you enough for another fantastic interview. It's always a pleasure to have you on the program. You already mentioned Merk Funds, MERK funds.com is where people can find your product offerings. But that's not all that's there. I think you also have, I don't know if you call it a blog or research notes or white papers, but what other free stuff can our listeners find there?
Free stuff. Don't we love that all? I mean, the best thing really to do is to follow me on Twitter. Twitter.com/Axel Merk. Axel Merk is my Twitter handle. And the reason I say Twitter is a fantastic news outlet because you get the instantaneous interpretation of news, not just from me, but other folks that obviously you might appreciate. Sometimes I blog a lot, or tweet a lot, sometimes very little. When there's a press conference, rather than taking notes, I tweet live. So if you look me up on around ECB press conference times, you probably see a dozen or so tweets. Otherwise, a little bit more sparingly. And then we do have a newsletter at merkinvestments.com. That's also free. Our primary goal and mission is to manage money for investors, and so we don't have a strict scheduling. When we publish something, we publish it as we get to it, but we hear that people appreciate those a lot. And by the way, we do publish cartoons in these sometimes, and some people only sign up because of the cartoons.
Well, again, I can't thank you enough. Again, folks, Axel is on the web at merkinvestments.com and on Twitter at Axel Merk, AXELMERK. Thanks again, Axel. Patrick Serezna and I will be back as MacroVoices continues right here at macrovoices.com.
MacroVoices is a listener-driven program. Please email requests for specific future interview guests to requests@macrovoices.com. You can email questions for the program to mailbag@macrovoices.com, and we'll answer them on the air from time to time in our mailbag segment. We also welcome your suggestions for how we can improve the program. Now, back to your hosts, Erik Townsend and Patrick Serezna.
Erik, what a great interview with Axel. You know, what stood out for me in the interview had to have been when you were talking to him about China, and particularly what he thought about the whole Yuan deval. And he responded by saying that was his base case scenario. What stood out for you in the interview?
Well, that was it. The words base case. You know, we used to ask people, well, what do you think of Kyle Bass's crazy out there idea that China's going to blow up the world with a wave of deflation? And people would tell us that it was nutso or Kyle smoking dope or whatever. Now there's people saying, oh, that's my base case. My assumption is that China's going to blow up because of this massive credit expansion that they've been through. And it's just a question of when it's going to happen and what the consequence will be. And I agree with that view. It's very, very hard to time these things. Big ships change course very slowly. So, you know, when you're talking about nations like China, it could take several years before this falls apart. But boy, that credit expansion that they've seen has to have some kind of consequence. Anyway, I want to move on to something I brought up earlier in the program. I mentioned, because I primarily trade futures, that I noticed the E-mini S&P futures, the options on them just had this crazy skew. I see a chart that you've provided, and that'll be linked in our Research Roundup email so our listeners can follow along. You prepared a chart, Patrick, which is not the futures, but the actual SPX index and the options on that index. And you're seeing, of course, the exact same thing that I saw, which is this crazy volatility skew where puts are much, much more expensive than calls. So you're the options guy. Before we move on to the rest of what you've got prepared here, what is the market telling us? What does it mean when puts are selling for much more than calls are?
Well, first off, I prepared this chart largely because I wanted to compare this to the gold skew. And this was, I wanted it for a comparative purposes so we can reference two things, but it really brings up an interesting conversation in regards to the natural shape of a volatility skew. Now, because of the nature of markets, there's that old adage that markets rise like an escalator but drop like an elevator. And that often is reflected in options in a sense that it has to have a fat tail risk in the put premium, that the higher implied volatilities have to be on puts because the risk that there's some big market event can always be there, and the put sellers need to be compensated for that risk. So naturally, when you're looking at this chart, you're seeing that the implied volatilities are very high on the farther you go out of the money on these put options, and it actually is quite normal for there to be a skew. And so I don't want to point this out that this is some sort of massive abnormality, but really, actually, it seems to be amplified more than normal. And what you're looking at here is that for instance, if we just look at a caller, a common strategy is to buy the S&P 500. I'm going to turn around, sell a covered call for income, and use the proceeds to buy a protective put. And usually people try to open that at a zero cost. You know, they want to be able to collect as much income as it costs, and you sort of hedge wrap your S&P 500 trade in there. But what we're seeing here is that the implied volatility when you go 10% out of the money on the S&P is that with implied volatility, the SPX was 16.7%. And now if you turn around and you go 10% out of the money for the call, the implied volatility was around 8.8%. And now this is massively reflective in the option premium when we look at a comparative option. So when I show you the option quotes underneath, one can see that to buy a 10% out of the money put, I mean, I rounded it at around the $2,200 strike on the S&P 500 was $33 to buy a protective put on the downside risk below 2,200 on the S&P. While if we, let's say, went roughly 10% higher, let's say somewhere near the 2,700 strike on the S&P, that option premium is trading just around $3. So you're talking about literally 1/10 of the cost of the put would be covered with the covered call. It just shows you how skewed this is. And that was, by the way, out to the December expiration.
So the big thing that brings to my mind, Patrick, is everybody's worried about the downside. And this is this kind of bizarre, logical conundrum that when everybody's worried about the downside, people load up with protection. And when everybody's protected, when everybody's bought those protective puts, you almost cannot get a market crash under those circumstances because everybody's already bought their insurance and there's nothing to panic over. So the big question this brings to my mind is, what does the open interest look? And particularly, are there any clusters of high open interest around certain strikes that might tell us where everybody's buying that protection? Because if there's big clusters, that really says something to me about kind of a floor in the market, wherever that level is.
Well, the first observation I make is that there is a huge amount of June expiration options out there that make up a very large amount of the open interest. And the belly of the curve for open interest lies between the 2,300 to the 2,400 level on the S&P, all below the market. And particularly, there's three strikes on the S&P, the 2350, 2375, and the 2400 strike prices where there's substantial amounts of open interest. Now, with us literally just a week away from options expiration, we're in a situation where there is a substantial gamma risks, particularly if it's all market makers on the short side of those options. Now, more often than not, very similar to what you were suggesting, that may actually pin the market above 2,400, and actually it's quite likely that we may stay up here. But it actually, though, has a catch to that, which is that if for whatever reason a market event was to cause the market to blow through those strike prices to the downside, that would skyrocket the gamma and delta exposure that the short side is exposed to, and can actually act like fuel or accelerant to the downside. So I would say on balance, it's more likely than not that we're going to actually stay above 2,400 until we roll out these options off of the thing. But if for whatever reason something triggered something, that actually would be something that could actually create an event.
So another way to put that is, we got a lot of trouble getting through 2,400 to the upside. There was a lot of resistance there. And the rule of thumb is the more resistance there was on the way up, the more support there's going to be on the way down. So there should be strong support at 2,400, but if it breaks, watch out below. Is that essentially what you said?
Oh, absolutely. But these options only have another week till expiration. So this entire open interest thing will be changed a couple of weeks from now. We can always, go for another update a couple of weeks from now in our next, couple of shows. But right now, that's definitely the case for at least up until the 15th and the 16th next week.
Now, I want to move on to your next chart because what you're showing us here is basically everybody's worried about downside. They're paying through the nose for downside protection. But the cost of those calls that would allow you to profit from the upside is very, very minimal, which means the people that are selling the options don't think it's going to happen. But if you look at gold, the story is almost reverse. It seems like they're more worried about a move to the upside than the downside.
Oh, that's exactly it. And this is the reason I really put up that S&P chart for comparative purposes is to show everyone what the gold futures volatility skew is, and just the way that the premiums are dynamically different in the gold market. And this is actually quite similar in the treasury market, which I don't have a chart here of. But what you're seeing is a far more symmetrical distribution in terms of the volatility distribution. And what you're really seeing is that the implied volatility are pretty equal, about 10% higher or lower. But if we, let's say, went out and went for the remainder of the year on gold futures, and we basically said, look, let's collar this. Let's create a scenario where we're going to buy some protection on gold and we're going to use a covered call to pay for it. Well, if we, let's say, went down to about the 1150 level on gold, about 10% lower, you can see it costs us about $9 an ounce to buy a protective hedge for the remainder of the year. At the same time, to go, let's say, 10% out of the money on the covered call, somewhere just above 1400, in this case the 1410 strike, you're getting a $16 covered call income premium against that. So you actually not only paid for the put, but actually have a positive carry.
So just to summarize for our retail audience who may not know all of this terminology, by saying a positive carry, what you're saying is you do some fancy footwork with buying and selling options, and you end up with protection that limits your downside. It comes at the expense of also limiting your upside, but not as much as it's limiting the downside. And you actually get paid for that. It's not a question of paying an insurance premium to get that coverage. It's receiving a small premium for the combination of options that you've manipulated in order to create this collar. That's a pretty impressive move.
You know what's interesting about that, Eric, is that because this is on the futures markets, obviously one can hold a gold futures contract, and you can even go into the ETF and do this on the GLD. But a lot of our listeners may actually have physical gold, and will see the value in hedging. You could, as long as you come up with the margin required to maintain this position, you could go in there and build this collar and synthetically be hedging physical bullion that you have in your own account.
Okay, I want to move on to your third chart because it almost looks to me like you're saying, the downside is only $100, but you still get to profit from $200 of upside. How is it possible that you get paid for this options position when it's actually giving you more upside than downside? That doesn't make sense.
So what I'm trying to show here on the chart number 3 is the fact that we can actually create a really neat asymmetric trade in gold where we can limit our downside and have a lot more upside and do it actually at just a small debit. Now this particular trade setup I have here is actually it costs a debit. It costs about $2.50 to do this trade. But if you notice here, what we're talking about is buying a put protection, which is about $100 lower on gold from where it's trading, with right around $12 a contract. And at the same time, you could sell a covered call going up, let's say, up to $14.75, which will net you an income around $9. So for a $2.50 debit, you can turn around and actually create a 2-to-1 risk-reward ratio for gold for the remainder of the year, where you've limited all downside risk below $11.75, and you have all of the upside potential up to $14.75. And so I just found it really interesting that the volatility skews are slanted in such a way that you can create this kind of bullish asymmetry for gold.
Well, I really enjoy seeing all of these different tricks you can play with options in order to achieve so many different hedges and so on and so forth. Now, for people who want to find out even more about this, Patrick is in the business of teaching people about trading, and options is just one of the courses he teaches. We're going to have to leave it there, though, for this show because we are running out of time. We do need your help promoting the show, so please retweet us when we announce the show. Tell your friends about it. Forward your Research Roundup emails. Use our new donate button on the homepage if you'd like to donate to help defray our production expenses. You can use the player embed on the homepage to put a MacroVoices player on your own website. But most importantly, please register your free account at MacroVoices.com, because the more registered users we have, the more able Patrick is to negotiate to get the very best guests on the program. The benefit to you is you'll receive our free Research Roundup email blast each week. Never contains any marketing or advertising. It's always nothing more than a compendium of links to cool free stuff, both handouts and supporting material from our feature interview guests, as well as the best content that we could find on the internet for free each week. Patrick, what's in this week's Research Roundup?
Well, first off, you'll find a link to the transcript for today's interview with Axel. As well, you'll find a link to the charts that Erik and I discussed in the post game here on the S&P 500 and on gold. As well, there's an article from Kessler titled "The Business Cycle is Fully Ripe," and it was really interesting to kind of look at the unemployment rate chart comparison that they put out there to kind of show what stage we are in the business cycle. As well, there's a link to an article from the guys at Macro Ops titled "How Short-Term and Long-Term Debt Cycles Work." Now, you could find this and so much more in this week's Research Roundup. So that does it for this week's episode. We appreciate the feedback and support we get from our listeners and are always looking for suggestions on how we can make the show even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we'll include it in our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend. On behalf of Erik Townsend and myself, thank you for listening, and we will see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.